Have you ever checked the news and seen that the dollar is up against the euro? Or that the yen is crashing? Or that some currency you've never heard of just lost 20% of its value overnight? Here's what nobody tells you. These aren't random events. They're not acts of God. Every single day, currencies are rising and falling based on forces that most people don't understand at all. And here's the really wild part. These movements affect your life whether you pay attention to them or not. They determine how much your vacation costs, how expensive your iPhone is, whether your job even exists tomorrow. But most people have no idea why currencies move. They just accept it as some mysterious force, something that happens in the background, something only economists and traders need to understand. That's completely wrong. And once you understand why currencies rise and fall, you'll see the global economy in a completely different way. Here's what's really happening. Most people think currencies are like stocks. They go up when things are good, they go down when things are bad. Simple, right? Not even close. Currencies aren't like stocks at all. When you buy a stock, you're betting on one company. When you trade a currency, you're betting on an entire economy versus another entire economy. You're comparing two countries, two central banks, two different governments making two different sets of decisions. Think about it this way. When you see that the dollar is up, that doesn't mean the dollar got stronger in isolation. It means the dollar got stronger relative to something else. Maybe the euro got weaker. Maybe the yen collapsed. Maybe both happened at once. Every currency is constantly being measured against every other currency. It's like an endless competition, a never-ending beauty contest where the judges are constantly changing their minds about who looks best. And here's where things get really interesting. The value of a currency isn't just about economic fundamentals. It's not just about GDP growth or inflation or trade balances. Those things matter, sure. But currency movements are driven by something much more complex and much more human. They're driven by expectations, by psychology, by fear and greed and hope and panic, by what people think will happen, not just what is happening right now. Let me show you exactly what I mean. The first force that moves currencies is what I call the interest rate game, and this is probably the single most powerful force in currency markets. Here's how it works. Every country has a central bank. In the United States, it's the Federal Reserve. In Europe, it's the European Central Bank. In Japan, it's the Bank of Japan. And these central banks set interest rates. Now, when a central bank raises interest rates, something interesting happens. Money from all over the world starts flowing into that country. Why? Because investors can get better returns there. Think about it from an investor's perspective. Say you have $1 million to invest. You can put it in U.S. bonds, paying 5%. Or you can put it in Japanese bonds, paying 0.5%. Where are you going to put your money? Obviously, you're going to choose the higher return, which means you need to sell your yen and buy dollars. And when millions of investors around the world make this same calculation, all that buying pressure pushes the dollar up. This is why currency traders obsess over central bank decisions. When the Federal Reserve raises interest rates, the dollar usually rises. When the European Central Bank cuts rates, the euro usually falls. It's not a perfect relationship, but it's powerful. But here's where it gets tricky. Markets don't wait for interest rates to actually change. They move based on expectations of what central banks will do. If traders think the Fed is going to raise rates next month, they start buying dollars today. If they think the Bank of Japan will keep rates near zero, they sell yen now. This is why you'll see currencies move dramatically on days when nothing actually changed. Just the expectation of change is enough. The anticipation. The belief about what's coming. And this creates this weird dynamic where currencies move on rumors, on hints, on carefully worded statements from central bank officials. Traders are constantly trying to read between the lines, to predict what central banks will do before they do it. Let me give you a concrete example. In 2022, the Federal Reserve started raising interest rates aggressively to fight inflation. They went from near 0 to over 5% in less than 2 years. And during that time, the dollar absolutely soared. It hit its highest level in decades against most major currencies. Why? Because investors around the world wanted those higher returns. They sold euros and yen and pounds and bought dollars, and all that buying pressure pushed the dollar way up. Meanwhile, other countries were stuck. The European Central Bank was slower to raise rates. The Bank of Japan refused to raise rates at all, so their currencies got crushed. The yen fell to its weakest level in decades. The euro dropped to parity with the dollar for the first time in 20 years. Same global economy, same timeline, but completely different interest rate policies led to massive currency moves. The second force is what I call the trade balance push and pull, and this one is more intuitive but also more complex than most people realize. Here's the basic idea. When a country exports more than it imports, it runs a trade surplus. When it imports more than it exports, it runs a trade deficit. And these trade flows create constant pressure on currencies. Let me walk you through how this works. Say you're a German car company, and you sell $1 million worth of cars to the United States. You get paid in dollars. But you can't pay your workers in Germany with dollars. They want euros. So you have to sell those dollars and buy euros. Now multiply this by every export transaction happening every single day. German companies selling cars, Japanese companies selling electronics, Chinese companies selling everything. All of them getting paid in foreign currency and needing to convert it back to their home currency. This creates buying pressure on currencies from countries that export a lot, and selling pressure on currencies from countries that import a lot. This is part of why China's currency, the yuan, has been relatively strong for decades. China exports massively more than it imports. All those exports create constant demand for yuan as companies convert their earnings back to local currency. Meanwhile, the United States runs a huge trade deficit. We import way more than we export. This creates constant selling pressure on the dollar as U.S. companies buy foreign currency to pay for imports. But here's where it gets weird. Despite running a massive trade deficit, the dollar is still the world's reserve currency. It's still considered strong. How is that possible? Because trade flows are just one piece of the puzzle. They matter, but they're not the whole story. Other forces can easily overpower them, like interest rates, like safe haven flows, like the fact that most global trade is conducted in dollars regardless of who's buying or selling. This is what makes currency markets so complex. You can't just look at one factor. You have to understand how all these forces interact, how they reinforce each other or cancel each other out. The third force is the fear trade, and this one explains some of the most dramatic currency moves you'll ever see. Here's what happens. When things get scary in the world, when there's a financial crisis or a war or a pandemic, investors panic. And when they panic, they run to safety. They sell risky assets and buy safe haven assets. And in the currency world, there are two main safe havens: the U.S. dollar and the Japanese yen. Sometimes the Swiss franc, but mostly those first two. Why the dollar? Because the United States has the deepest financial markets, the most liquid assets, the strongest military, the most stable political system, relatively speaking. When the world gets chaotic, people trust that the U.S. will still be standing. Why the yen? This one is less obvious. Japan runs huge trade surpluses. Japanese investors own massive amounts of foreign assets. When things get scary, they bring that money home. They sell foreign assets and buy yen. This creates huge buying pressure on the yen during crises. Let me give you a concrete example. In March 2020, when COVID hit and markets crashed, what happened to the dollar? It surged. Even though the pandemic was devastating the U.S. economy. Even though the Fed was slashing rates, the dollar soared because everyone wanted safety. Or, look at what happened in 2008 during the financial crisis. The crisis literally started in the United States. U.S. banks were collapsing. The U.S. housing market was imploding, and yet the dollar strengthened because investors around the world were fleeing to safety. This seems completely backwards, but it makes sense once you understand the psychology. In a crisis, you don't want the currency with the best economy. You want the currency that will definitely still exist when the crisis is over. You want liquidity. You want depth. You want to know you can sell your assets if you need to. The dollar provides that. So does the yen. So when fear takes over, these currencies rise even when their economies are struggling. This creates this perverse dynamic where bad news for the U.S. economy sometimes leads to a stronger dollar. Not because the economy is doing well, but because fear is driving flows. The fourth force is what I call the government intervention factor. And this one shows you just how much governments can manipulate currency values when they want to. Here's the thing most people don't realize. Currencies aren't purely free market. Governments actively try to influence their value, sometimes subtly, sometimes very aggressively. Why would a government want to weaken its currency? Because a weaker currency makes your exports cheaper and more competitive. It makes it easier for your companies to sell goods internationally. It can boost your economy by making domestic products more attractive than imports. Why would a government want to strengthen its currency? Because a stronger currency makes imports cheaper. It keeps inflation down. It makes your citizens feel wealthier when they travel abroad. It attracts foreign investment. Different countries prioritize different things, and they use their central banks to try to achieve those goals. Let me give you the most dramatic example. For decades, China kept the yuan artificially weak. They did this by buying massive amounts of US dollars. When you buy dollars, you're selling yuan, and when you sell huge amounts of your own currency, you push its value down. Why did China do this? To keep their exports cheap, to maintain their competitive advantage, to keep their economy growing through manufacturing and exports. This worked incredibly well for China, but it created massive trade imbalances. The U.S. ran huge deficits. China accumulated trillions in foreign reserves. Eventually, international pressure forced China to let the yuan appreciate. But for decades, they actively suppressed its value. Or look at Japan. For years, the Bank of Japan has tried to weaken the yen. They've kept interest rates at zero or even negative. They've bought massive amounts of government bonds. They've done everything possible to push the yen down. Why? To fight deflation, to boost exports, to make their economy more competitive. Sometimes this works, sometimes it doesn't. Because when you're trying to manipulate your currency, you're fighting against all the other forces, against market expectations, against trade flows, against fear and greed. It's like trying to hold a beach ball underwater. You can do it for a while, but it takes constant effort, and eventually, market forces often win. But here's what's important to understand. Governments have enormous power to influence currencies, at least in the short to medium term. They can print money, they can set interest rates, they can buy and sell currencies directly. They have tools that individual traders don't have. So when you're trying to understand why a currency is moving, you can't ignore what the government wants, what their policy goals are, what they're willing to do to achieve those goals. The fifth force is what I call the expectation cascade. And this might be the most important one of all, because it shows you how psychology drives currency markets even more than fundamentals. Here's how it works. Currency values aren't just about what's happening now. They're about what traders expect to happen in the future. And those expectations can become self-fulfilling prophecies. Let me walk you through a typical scenario. Say traders start to believe that the euro is going to weaken. Maybe they think the European Central Bank is going to cut interest rates. Maybe they think Europe's economy is slowing down. Whatever the reason, they believe the euro will fall. So what do? They sell euros and buy other currencies. And when enough traders do this, the euro actually does fall, which confirms their belief, which makes them sell more, which pushes the euro down further. This creates momentum, trends, self-reinforcing cycles. The expectation of weakness creates actual weakness. The belief becomes reality. This is why currency markets can trend for months or even years. Once a belief takes hold, it feeds on itself. Traders see the trend. They jump on board. The trend gets stronger. More traders join, and the currency keeps moving in the same direction until something breaks the trend. A surprise economic report. A central bank announcement. A geopolitical event. Something that makes traders question their assumptions. And then the whole thing can reverse just as dramatically as it started. Let me give you a concrete example. In the mid-2000s, everyone believed the U.S. housing market would keep going up forever. This belief attracted foreign investment, strengthened the dollar, created more confidence, which attracted more investment. A self-reinforcing cycle. Until it wasn't. When the housing market crashed, the belief shattered. Foreign investors pulled out. The dollar weakened, the cycle reversed, all because the underlying expectation changed. This is what makes currency trading so difficult. You're not just trying to figure out what's happening now, you're trying to figure out what other traders think will happen, what they expect, what they believe. And then you're trying to predict when those beliefs might change. It's like a massive game of poker where everyone is trying to read everyone else, where the cards don't matter as much as what people think the cards mean. And here's the really tricky part. Sometimes currencies move for no good reason at all. Just because enough traders decided to buy or sell. Just because momentum built up. Just because the trend was going that way. It's not always rational. It's not always based on fundamentals. Sometimes it's pure psychology, pure speculation, pure momentum. But here's what nobody wants to admit. This makes currencies incredibly difficult to predict. Even professional traders with all the data and all the analysis get it wrong constantly. Because you're not just predicting economic fundamentals, you're predicting human behavior, mass psychology, collective beliefs. Let me tell you about two investors. Both had some money to invest in international markets. Both thought they understood currencies. But they approached it completely differently. Meet Tom. Tom read some articles about currency trading. He learned that high interest rates attract investment. So he developed a simple strategy. Find the country with the highest interest rates. Buy that currency. Wait for it to rise. Seems logical, right? Higher rates should mean a stronger currency. That's what all the articles said. That's what the theory predicted. Tom found that Turkey had interest rates around 20%, way higher than the U.S. or Europe. So he converted a bunch of dollars into Turkish lira. He was confident. The high rates would attract investors. The lira would strengthen. He'd make a killing. But here's what Tom didn't understand. High interest rates don't always strengthen a currency. Sometimes they're high because the country is desperate, because inflation is out of control, because investors are fleeing and the central bank is trying to stop the exodus. Over the next year, the Turkish lira crashed. It lost more than half its value against the dollar. Tom's investment got decimated. Yes, he was earning 20% interest, but the currency fell 40%. He lost a huge amount of money. Tom couldn't understand what happened. He followed the rules. He bought the high-yielding currency. It should have worked. But he only understood one piece of the puzzle. He ignored all the other forces. The political instability. The inflation problem. The loss of investor confidence. He thought currency trading was simple. It's not. It's incredibly complex. And oversimplifying it cost him dearly. Now meet Lisa. Lisa also wanted to invest internationally, but she approached it differently. She didn't try to predict currency movements. She didn't think she could outsmart the market. Instead, she focused on diversification. She spread her investments across multiple countries, multiple currencies. She accepted that currencies would fluctuate. Sometimes they'd help her returns, sometimes they'd hurt. But over the long term, the diversification would protect her. She also used her understanding of currency risk practically. When she planned a trip to Europe, she kept an eye on the euro. When it was relatively weak, she bought euros for her trip. She didn't try to time it perfectly. Just waited for a reasonable exchange rate. When she bought foreign products, she understood why prices fluctuated. She knew that when the dollar was strong, imports were cheap. When the dollar was weak, imports were expensive. This understanding helped her make better timing decisions on big purchases. But most importantly, Lisa respected the complexity. She didn't pretend to predict the future. She didn't think she could beat professional currency traders at their own game. She used her understanding of currency movements to make smarter decisions, not to speculate. 10 years later, Tom had lost money trying to trade currencies. He'd made several more bets based on incomplete understanding. Each one seemed logical. Each one lost money. He finally gave up, frustrated and poorer. Lisa had built a well-diversified international portfolio. She'd saved money on foreign purchases by being patient. She'd protected herself from currency risk through diversification. She didn't get rich from currency movements, but she didn't get crushed by them either. The difference wasn't intelligence. It was approach. Tom thought currencies were simple. Lisa understood they were complex. Tom tried to exploit them. Lisa tried to understand them. Tom bet on predictions. Lisa bet on diversification and patience. Here's what most people don't realize. Currency movements aren't random, but they're also not simple. They're the result of multiple forces all interacting at once. Interest rates, trade flows, fear, government policy, expectations, psychology. It's not about being smart enough to predict the next move. It's about understanding the forces at play. about respecting the complexity, about using that knowledge to make better decisions, not to gamble. The professionals who succeed in currency markets don't succeed because they can predict the future. They succeed because they understand probabilities. They manage risk. They don't bet the farm on a single view. They stay humble in the face of complexity. And for everyday people, the lesson is even simpler. Understand how currencies move so you can make smarter decisions. So you understand why your vacation got more expensive. So you know when to buy foreign products. So you can protect yourself through diversification. But don't fool yourself into thinking you can consistently predict currency movements. Even the smartest people in the world with the most sophisticated models get it wrong all the time, because currencies are driven by human behavior. And human behavior is inherently unpredictable. Interest rate differentials, trade imbalances, fear trades, government intervention, expectation cascades. These aren't mysterious forces. They're understandable patterns. But understanding them doesn't mean you can predict what happens next. It means you can navigate the global economy more intelligently. You can make better decisions about international investments. You can time foreign purchases more strategically. You can protect yourself from currency risk. The question isn't whether you can outsmart currency markets. The question is whether you understand them well enough to make smart decisions in a world where currencies are constantly shifting, where the value of money itself is always changing, where the only constant is change, because currencies will keep rising and falling every single day. That's not going to stop, but now you understand why. And that understanding, that's worth more than any prediction could ever be.